Hi, everyone. Welcome to our webinar presentation for Coastline Capital Fund 5. My name is Andy Mirza. I'm with Coastline Capital Fund Management. My partner, Sean Irwin, is on the call as well. I'm pretty excited about doing this presentation. We have a lot more registrants and attendees than I was anticipating. So it's 2 minutes after 10. Let's go ahead and get this started. All right, the presentation will be short and to the point. 20-25 minutes max. Our time is valuable and so is yours. Following the presentation, we'll have a quick Q&A. You can send your questions to me via email or use the Q&A function at the bottom of the toolbar for you. Our intention is that by the end of this presentation, you'll know whether you want to join up with us or not. The webinar is being recorded, so if you miss anything, you'll be able to access it later and go over it. So here's our standard disclosure. It's long, so I'll summarize. And I got to get this out of the way first. We can't guarantee any of the results of our funds. Projections represent our best estimates. Past performance is no guarantee of future results. There are risks associated with investing in one of our funds, and you may lose some or all of your investment. Finally, this offering and solicitation is for accredited investors only. The webinar is not intended for non-accredited investors. So there are a couple handsome fellows right there. That's Sean, my partner, on the left, and that's me on the right. Sean and I create and manage funds that invest in defaulted mortgages, also known as non-performing notes. If you're not sure what those are, we're talking about home loans that have gone into default because the borrowers stopped paying. Most of what we deal with are leftover toxic loans from the financial crisis of 08. Believe it or not, yeah, we're still dealing with that kind of stuff. We have borrowers on some of our loans that haven't paid in 10 years. We make money for our investors by buying notes at a discount and liquidating at higher prices. And we prefer the severely delinquent loans because they have the highest returns. Think of us as fix and flip guys, except with loans instead of real estate. We buy loans that have something wrong with them. We add value by solving problems, and then we exit by foreclosing, selling the REOs, or reselling improved loans. Sean and I have been buying notes together since 2015. We've purchased a total of $7.8 million worth of notes. We've liquidated about half of them, $3.9 million, which resulted in almost $600,000 in net proceeds. The average weighted return on investment for these assets was 23.6%. The average weighted annualized ROI per loan was 30.2%. When COVID-19 hit in March, our market froze up. We didn't need to sell, so we didn't. We stood by on the sidelines like most everybody else and waited to see what would happen. As the weeks in lockdown rolled on, we could see that we were going to be okay. Looking back at March, the stock market dropped by a third. Oil even went negative, something I've never seen in my life. The worst thing that happened was that the timelines for some of our assets got pushed back a few months. No losses, no volatility. At this time, we have only a few remaining delays from the lockdowns, but these will soon end as states fully reopen. Loan pricing is not recovered yet. Note buyers are expecting 8 to 15% discounts from pre-pandemic pricing. There is still uncertainty on how well the economy will recover. Demand for real estate took a huge dive in March and April, but supply got even harder, hit it even harder. So demand outstripped supply. Real estate looks strong. Our business model assumes a flat market, but we do even better when prices go up. The current uncertainty gives us a limited window of opportunity before our market gets back to normal. We know that there are sellers that are still selling loans right now. As time goes on, though, the folks that really have to sell will do so at greater discounts because they need to. So for accredited investors who are dissatisfied with the current investment options out there, Fund 5 is a perfectly positioned distressed asset fund that provides the investor greater profit potential. Unlike bigger note funds like PPR or AMIP, Fund 5 offers the investor a preferred return and a profit split. It's run by a small, nimble team of experienced professionals. That's Sean and me. The two biggest factors to our success are access and speed of execution. This is from our website. Since 2009, we've spent considerable time and resources to develop and maintain excellent relationships with the traders and decision makers at Wall Street hedge funds in charge of selling institutional non-performing notes. This enables us to get preferred access to a large number of real estate notes for sale that aren't available to most other note investors. Buying real estate notes is not a problem for us. Banks and hedge funds buy and sell loans all the time like any other asset. When they buy big pools, they keep the loans they want and sell off the rest. The people that buy from them do the same thing. Finally, the loans end up with the investors that will keep or foreclose on them. Basically, the better your access and the higher up the chain you can buy, the better deals you can get. Also, the better your relationships are, you can also have the option, like we do, to pick individual loans instead of going all or nothing on pools of notes. It's really a unique thing. My partner Sean started in the industry in 2007 and did the hard work to develop those high-level relationships. I lucked out and walked into a partnership where I didn't have to do the same. I love Sean's story of how he finally broke into the Wall Street world, and it's definitely best coming from him personally. Sean, would you like to tell your story?
Sure. Howdy, everybody. Happy Tuesday. So just to give you a 10,000-foot overview of how Coastline all came about was 2007. I was sitting in a mortgage office, and a guy by the name of Stuart comes in my office and said, "Hey, Sean, have you ever heard about this bulk REO buying system from New York?" I'm like, I have no clue. What is that? He's like, "Yeah, you can go out there, you can buy $100 million worth of REOs at 50% discount. And you can go out there and make all kinds of money. Or if you broker it, you can find somebody that has a lot of money. You can pick up 1 or 2% and broker off those deals." So again, when I started hearing those numbers, I got really excited. I'm like, well, I got to look into this, right? So I started calling around. I had relationships with banks because I was doing originations at the time. And I started calling around to like small hedge funds and larger hedge funds. And as I started getting to know these guys and understanding what they were doing, they're like, "Sean, why are you looking at bulk REOs? Why don't you looking at non-performing notes?" And I'm like, "Well, what is that?" And he's like, "Well, what do you do for a living?" I said, "Well, I originate loans." Like, "Well, that's what it is. It's what you're originating. You give the money to the borrower goes out and they perform for 6 months and then they stop and then things go south for them, and we take them to the foreclosure. We do did and lose and all that good stuff." And I said, "So where is this? How do you make your money? How does this work?" And once they started explaining to me, it really started making sense to where instead of buying an REO where you have two outs, you either sell it or you rent it. That's your cash, right? You either get the profit or you get a cash flow income. As a note, you actually become the lender, which is what's exciting to me, because now you're in a power position of either working with the borrower, helping them get them reperforming again, where if they do that, we still are able to pick up a positive cash flow. Or say we bought that note at 60 cents on the dollar and we seasoned it for 12 months. Now we can go back to the banks and sell it for 100% or even above par to gain that pop at the end. So I was like, wow, this was a great idea. And so as things started unrolling, I started building these relationships with these guys back there. And a lot of the guys are, I don't know if you dealt with Wall Street, but they're very hard. Let's just say that in the beginning. So I like to use this as an example of kind of the frustrations and the hurdles that I had to jump through to get to where we are today. But I had met a guy named Todd. I don't want to give his last name, but he was with Chase, JP Morgan Chase. And he was a very high level guy, very, not too many levels down below Jamie Dimon. He ran their whole portfolio back east. And he was a very interesting guy when I met him at the conference. And then I said, look, I'm going to come to New York. I'm going to see you. And he's like, don't waste your time. You don't have any money. I could just hear it. And as we talk, I'm like, nope, I'm coming to New York. So I got on a plane. I went out there and I set up a bunch of meetings. Well, he was the first one. So I walk into the lobby, and back then security is very tight. You cannot just walk in these buildings and hit the button and go upstairs and there you go. So security stopped me and I said, look, I'm here to see Todd. And they called up to him, like, hey, tell Sean, hey, we're not having a meeting. Tell him, not interested, have him go away. Well, unfortunately, I'm a little more stubborn than that, and I will not take no for an answer when it comes to building this and putting food on my family's plate. So I stood there and I said, Todd, listen, if you don't let me up, I will cause a scene, and I'll probably go to jail, and you're going to probably have to come bail me out. So I just suggest you give me 5 minutes of your time, hear what I have to say. If you don't like it, hey, you never have to talk to me again. So finally, after push comes to shove, he's like, just come on up. So I get in the elevator, I go up, I walk in his door, he's like, I don't want to use the language on this call, but he's like, what are you doing here and why are you here? We already talked about this. I said, listen, I want a chance. I deserve the chance. We talked. I told you I can get the deals done. He's like, look, fine. I'm going to give you a $5 million a pool of our tape, or what we call them, of notes. And if you don't fund on this, at least a subset of this, you'll never do business in pretty much Wall Street again or in New York. He has that power. So I said, I took that risk. I said, fine. So I jump back on a plane, I go back home, and he sends me the tape. And my partners and I at that time did our due diligence. We came to a price where we wanted to offer. We made the offer. Of course, he wanted to play hardball. He prices up, and I said, guys, this is a do or die moment. We either come up a little bit to meet his demands and build these relationships, or let's just call it quits. Well, we came up to his pricing. We went into contract. We did our due diligence. We funded the transaction. Boy, after that, guys, it was like, woohoo! Hey, Sean, hey, what do you need now? Let's build a business. The word got out. Hey, I funded my deal. Everything's good, and that's where everything really kicked off. So I just started pounding down the doors in New York. I went to the Carringtons of the world, the Bayviews, the Fortresses. I could go on forever, guys, about how many trades. I think came to 120 trades with 120 different vendors, from hedge funds to banks. To regional banks that I did in the first 3 years with my group. We ended up funding $250 million in the first 3 years, which, for a guy that was in a very difficult situation when we were building this, and my poor wife had to endure for quite a while to get us the momentum going to where we actually made a paycheck. The feeling was unbelievable. So fast forward, my partners and I, we decided to part ways, and I came home and I said, honey, I'm going to do this on my own. I said, we need first to find out what's the name of the company. And she says, well, how about Coastline? I said, Coastline Capital. Perfect. And that's where it stuck. And that was in 2011. So that's when actually Coastline started. But I was doing this again since late 2007, 2008, when the crisis really started happening. But I just want to really go back and really touch on the relationships, how good we have it today. Back then, there's a lot of arguments with these guys. We're fighting for pricings. We're fighting. They wanted one price, we want another, and we the arguments were there. But during those arguments, we really built the bond, believe it or not, through the respect of, hey, you're standing your ground, we're standing our ground. There's got to be a common ground. Let's meet there. So we did, and we really started to get to know each other with me and with multiple funds on an individual level, not just, hey, they're the traders, or hey, they're the the CFO, or hey, they're the big guy. It wasn't like that anymore. It's like, hey, John, hey, or hey, Sean. It was a relationship built. I've actually got to know the guys so good back there. I've been invited to weddings. I know their kids. It's a really, I'm really blessed to be in that situation today for what happened in the past. These guys really, they really put up with me because I wasn't that easy back in the day, because I didn't, I like to stand my ground, and I fought for what was right, and I fought for what the company believed in, and that was a fair trade and a fair deal. But at the end of the day, we made it work. And again, to this day, we're still trading with the same partners that we were trading from the very beginning, which is really cool. And then I got to watch these guys grow up, which is really cool for me, because I was always the old guy. We'd go to New York, and we'd be out having cocktails, just entertaining and just having fun. And I was the old man, so I'm like, oh my gosh, I got to go to bed. So years later, it's great when I go out there. It's like, let's meet for dinner. It's 9 o'clock, Sean. I got to be home to tuck the kid in by 10. I'm like, yeah, I can go to bed early. It's all good now. So what benefit from that is now the guys that we trade with, they actually when they have when I ask for product, when we go out and do a money raise, I go out and ask for product. And instead of them saying, Sean, we're going to take it to market, everybody's going to bid, and the highest bid wins, they actually send me their whole portfolio or the states that I'm actually looking to buy in. They'll send me that tape of specifically carve out for our needs. And then what happens is Andy and I, we go in there, we do our due diligence, we look at it every way from run one, we go in there, we make a price that we actually, whether it's $10 million we're looking at, and then we only fund 2 loans out of that, they're okay with that, and they'll still do the trade if it works for both parties. You don't get that anywhere when you're, it's just very hard to find that in other funds and have that ability. And if they were on the phone today, they'd vouch for it without a doubt. Again, it started with the arguments and building that trust and building the relationships of Sean. The biggest thing is if you don't fund your transactions, you will be blackballed. And that blackball word is a strong meaning in New York. I've seen guys with 500 million cash that they were very arrogant. They thought they owned the world, and people would not trade to them. For $500 million, they wouldn't even trade to those guys. That's saying something. Those guys have a lot of pullback there. So, but having the grit not to give up, I don't like to toot the horn, but at that time I had no choice. I had a family to feed. We were in a dire straight situation, and I carried that attitude and that sheer willingness not to give up for a long time until I met Andy, where when Andy's my total opposite, and you guys will get to know him. He really taught me a lot of things about how to back off, how to be more communicative, how to understand other people and how they are, not to be so hard and direct. And I believe I still am a little bit that way today, but again, it comes from, I believe in fairness, and I want to make sure that the investors in the company are treated fair, and that's my job. But he's really taught me how to have a different approach. Sometimes it works, sometimes it doesn't. I use the phrase, they either love me or hate me back there, because I do have a lot of people probably don't like me because I thought they're trying to rip us off, and I let them know. Anyways, but to continue this conversation, partnering with Andy was like one of the best things that ever happened to me. This guy comes in, open-minded, willingly wanted to jump into the space, and it was really awesome to go, wow, look at this guy. I would love to have you as my partner. So like you said, we've been partners for quite a while now, and he's taken on a huge role for the company. He knows everything from under the sun. He has access to everything I have access to. So like I said, this to where we are today wouldn't be without Andy, because he also brought value in by bringing investors to the company, where before I was just using our capital and maybe a one-off partner that we just go buy 4 or 5 loans, and that's what we did. Andy wanted to ramp things up and become a bigger stake, to have a bigger stake in this space. So I was a little reluctant, but we got through it. He got me through it, and here we are today. Now we're on our 4th fund. We call it Fund 5 because Fund 1 anyways, we won't talk about Fund 1, but Fund 2, Fund 3, Fund 4, we're working through Fund 3, Fund 4, and they're liquidating as we speak. Andy can maybe go over that with you. And we've completely closed Fund 2. Everybody got their money, and all those investors moved up to us, which is cool. But guys, like I said, the ability to have the relationships we have is bar none. I don't know very many people out there that have that ability. And again, it goes back to these guys allowing Coastline to be that trading partner with them. So that's kind of the 10,000 overview view of my experience from how I started with Coastline to where I met with Andy to where we are today and where we're looking to grow to. And if you guys want to know more about me personally, I have no problem taking phone calls. If you guys want to shoot me a call, you're more than welcome to. I'd love to tell you the stories or the experiences and the trials and tribulations we've been through, because there sure are a lot, and we've overcome, and now we're sitting in a very good position, especially where the market is today. So by that, guys, I'm going to turn it back to Andy, and if anything I missed, please feel free to let me know. But I'm going to turn it back to Andy now. Thank you very much, guys.
All right. Thanks, Sean. I appreciate you sharing your story with us. I really can't overemphasize how important that access that we have is. I didn't really realize how good we had it until I started reaching out to other people on bigger pockets and other note investors to see that we do have pretty unique relationships and access. So the second part of our keys to success are the speed of execution. This is also from our website. We're small and nimble compared to the big banks and hedge funds. To the big guys, each note is just a number. We're different. We give each non-performing note the attention it requires to enable us to get the greatest returns as quickly as possible. We make decisions quickly with a mindset of what's best for the fund and our investors. And you got a sense of that when Sean went talked about the access we have and how we do business together. So the big banks and large hedge funds are slow and don't seem to be in any hurry to get things done. They're great when things go well, like having tens of thousands of performing loans, but they're terrible at dealing with borrowers when the notes go non-performing. They can't seem to get things right when dealing with the hundreds of steps required for a successful foreclosure. I use a Chicago loan as a perfect example of this. We were looking at buying a loan with property in Chicago, Illinois, and saw that the foreclosure was delayed because our seller took a year to get the right document to their attorney. It took a full year for one document. When you have hourly or salaried employees whose compensation is not directly tied to any one particular asset, you have a problem with misaligned incentives. Employees are doing what they have to do to keep their bosses happy and keep their jobs. They don't care about any specific asset. For this loan, the assignment took weeks to get prepared, analyzed, and processed before making its way to the attorney. They sent it back because the document wasn't correctly prepared. By the time the seller fixed the problem and sent it back, 1 year had passed. We ended up buying that loan. It took us 2 weeks to do the same thing that took the bank 12 months. Things are a lot different for us since we are the owners and caretakers for our investors. No one cares for an asset like an owner does. There's a sense of urgency in how we conduct our business. We don't tolerate unnecessary delays from any of our vendors. When we buy loans, there are usually issues that have stalled their progress toward resolutions. We find those issues wherever they are, we fix them and get them back on track for whatever liquidation outcome is needed. Ever heard the saying that you make your money when you buy? Well, true with us as well. And Sean went into this as well as with our ability to go in and request tapes that are not available to other people, but are just for us exclusively. So when we're ready to buy, we get our sellers to send us the tapes. The tapes are Excel spreadsheets that list one loan per row. And our highest value is in our ability to scour those tapes, identify the loans that have the biggest profit potential, and to negotiate the best prices. We have our own financial model to aid us in bidding, but when it comes down to it, final selection is based on our combined knowledge and experience of our market, our sellers, and the current trends that affect our borrowers. I can't give it all away, otherwise it wouldn't be secret, but here's a little something. We all know that you try to get an informational advantage when negotiating. If your research determines that the value of a property is significantly higher than what the bank thinks it is, you have an advantage. To use a Chicago, Illinois loan as an example, the bank valued the underlying property at $99,000. We knew that the property was actually worth about $140,000. Because of this difference in belief, the seller accepted our $59,000 bid, which is acceptable to them at 60% of value. In reality, using our numbers, we bought that loan for 42% of value, a considerably better deal. So let's get to Fund 5. So Fund 5 is a single-purpose, non-leveraged, close-ended investment. It has a 3-year maximum time commitment, but that can be much shorter depending on the liquidations. It offers an 8% preferred return, plus 60 or 50% of the profit split. The minimum investment is $25,000, and that could be waived at management's discretion. And as a matter of fact, we're going to do a couple things with our future funds. Anybody who invests in prior funds, like 3, 4, or this one, when the next fund comes up, they'll be able to do less than the minimum amount, because we know that some investors will be in between investments, and we just want to give them that option and that flexibility. It's available to accredited investors only, and for this fund in particular, you need to prove your status. We project that the combination of the preferred return and the profit split will equate to a 15% per year return to the investor. The minimum fund offering size is 500,000 and the maximum fund offering is 5 million. So this is how it works. So the fund will close to new investment on July 31st. Once we close to investment, we will proceed to buy one or more pools of non-performing notes, which will take about 1 to 3 months. It's important that once July 31st rolls around, we're not taking any new money in. Whatever investors in capital we have at the time, we're all in it together for the duration of the fund. We'll proceed with note liquidations over the next 3 years. But based on our experience, most note liquidations take 6 to 18 months. Instead of 3 years, if we liquidate everything in 2 years, it'll be done earlier. Once we start liquidating, we will not buy more notes. So it is not a revolving fund that continues to buy notes. We buy that first pool of notes and that's it. Net proceeds of note liquidations. So beyond what we need to keep in reserve, it'll be distributed in the following order. So we like to maintain the right amount of reserves. And whenever we have liquidations, we look at what our upcoming operating expenses are, what kind of rehabs we have coming up, and we want to make sure that we have enough for that. We do not want to do capital calls at all, and I don't think any investors out there like them either. So, but anything in excess of that is going to go 100% to pay back investors' initial contribution. We want to make sure our investors get their initial capital back first before we do anything else. Then the next proceeds will be used to pay the 8% preferred return that accrues on investors' contribution while it was in the fund. So for example, if you invested 100,000 into our fund and it takes us 1 year to pay back that 100,000, you will have accrued 8% or $8,000 on that 100,000. So that $8,000 is the next in line to get paid. So everybody who's accrued their preferred return gets paid next. And then finally, the profit split. And then our fund is unique in that our investors participate in the upside. 60% goes to the investors holding Class A units and 50% to the investors holding Class B units. I want to make sure that you guys know that the distributions are only upon liquidations, which means that the distributions are going to be in irregular amounts and at irregular times. It's not going to be a regular payment each quarter or each month. Just I want to be clear on that. So as far as the fees to the fund, the management company, us, will charge Fund 5 a 2% management fee. This will be paid monthly once we acquire assets. It's based on the unpaid principal balance for the notes and market value for the REOs. There are no other fees. There are no acquisition fees, no capital raise fees, nothing. We want to make sure that our incentives were aligned correctly. So the bulk of our compensation comes at the end with a profit split. That's really what we're trying to get to. Once we get the notes, we're going to be working them as quickly as we can, and that's what we want to get to. So the current status of the fund, we've already raised in excess of 500,000. Now this means that the 8% preferred return is now accruing on all investments. It means that we have enough to commence operations, so July 31st is a hard deadline. We're not going to extend it. And then there are no more Class A units available. The remaining investments will be for Class B units only with a 50-50 profit split. The other new thing that we're going to do for future funds, not only are we going to waive the minimum investment for people that have already invested in our prior funds, but we're also going to open up the higher profit split. We're going to open up the fund earlier to any prior investors so that you'll have the first shot at being able to subscribe to higher profit splits. All right, we only have a few minutes left and I wanted to share a story with you. In the year before I met Sean, I was focused on fix and flips. I still had my day job as a security contractor overseas and would work on real estate full-time in between deploying to Iraq. I found what I thought was a fantastic high-end flip in Orange County, California. You're looking at a picture of that house, and it always, whenever I see that picture, it provokes an emotional response in me. Anyhow, I bought this exact house for $860,000. I had plans to do a light rehab and then quickly resell it for $1,050,000. With these projections, I'd make a quick 100 grand and be able to quit my overseas job and stay home with my wife and young kids. The contractor finished up the rehab as I left to go on a 2-month deployment. My wife would be my boots on the ground while I was gone. I got no offers for the first 2 months. I returned from Iraq and was able to devote my full time to the project. Still nothing. Two things were working against my plan. One, I should have done a larger, more thorough rehab to make the house more sellable. Two, the local real estate market suddenly stalled right when I took on the flip. It wasn't just me. All the houses in the area sat on the market in the area as buyers stopped buying. I had borrowed almost all the money for this project from a combination of a hard money lender and friends and family. I was burning through my reserves at the rate of $5,000 a month with no end in sight. If I didn't move this house quickly, my family and I would be in huge financial trouble. Another 2 months went by and I only had enough money for one more interest payment. That experience was incredibly difficult at the time and was the most financial stress I had ever experienced. I tell Sean that you get to know what people are really like in stressful situations. When things are going great, everything's easy. When things go bad, you get to see what people are really made of. Sean shared his story of persistence and hanging in there to do what he needed to do in order to provide for his family. We bring that same attitude of doing what we need to do to our business. We stay on top of things, we solve the daily problems that come up, and we don't give up. Fund 5 is the only fund out there that I know of that offers a profit split with the investors. The other funds out there that I mentioned before offer a preferred return, and that's it. Our investors participate in the upside with us. The opportunity to invest in Fund 5 is coming to an end soon. Before we close, we want to make this thing as big as we can and bring on like-minded investors that want to be a part of what we're doing. However, we've got to get going soon. You'll have to decide by July 31st. I got out of that flip the hard way, but it could have been worse. I approached the hard money lender and he found another investor to take over the property and the loan. I already came to the conclusion that the bleeding had to stop and that I was going to lose big instead of making a bunch of money. I sold the property at a loss to the investor, but wasn't able to pay back my family and friends. I made arrangements to pay them back over time. I lost $180,000 on the deal. Yeah, a little bit of money. I deployed to Iraq 8 to 9 months a year for the next 2 years, sold some rentals I co-owned, and paid every cent I owed plus interest to make everyone whole. It took a little while though, but out of all this, I learned not to over leverage. I learned that it's better to have equity partners. The benefit of spreading the risk far outweighs a smaller profit, and is another reason why we want to make this thing as big as possible. The more money we raise, the more notes we can buy, and the more we can spread that risk. I learned lessons on deal evaluation, planning, and execution. And I learned more about my own character and sticking things out and making things right for those that invested with me. You always think that you know how you're going to act, but it's not until it actually happens that you really find out. Today, our funds are not over leveraged. We spread our risk by buying lots of notes in different areas, mostly in the $70,000 to $250,000 range. And Sean and I have a really cool process for making decisions. He went over that a little bit earlier, but we really look at things separately before discussing our thoughts. We'll fight and argue over what to do, but at the end of the day, we know that we're each trying to do what's best for the fund, and we listen to each other's opinions. It's harder to overlook things when you got somebody who's always going to challenge your thinking. It's another thing that gives us confidence that we're making the best decisions possible. When it comes down to it, when you invest with Coastline Capital, you're getting Sean and me. You're getting our knowledge, attitude, connections, and grit. If you're ready to invest with us now, simply head over to our investor portal at investors.coastlinecapitalfm.com. You'll need to create a login profile. Then you can review the marketing materials and documents and subscribe to the offering online. If you want to do more due diligence before taking this step, start by exploring the resources on our website. I write a blog about the notes that we buy in detail. I write articles about our business. Reading these will give you an even better insight into our mindset and how we do business. You can also contact us by email or schedule a call with either myself or Sean. We can dive deeper into the details of the offering until you get the understanding you need. This concludes our presentation. Thanks for joining us. For those of you that can stick around, now's the time to ask some questions. I'm going to go ahead and turn my video back on so you can see me. And then if you'd like, you can send questions via the Q&A dialog box at the bottom of the screen. You can also email them. And I'm checking my email right now. Or you can ask to be unmuted, and I can do that. I have a question coming in right now. So, can I invest with a self-directed IRA? Answer is yes on that. There are no restrictions using an IRA to invest in one of our funds. All right. Okay, here's another question. Can I invest, or if it's just you two, how do you do all the work that's necessary to liquidate the notes? Okay, so that's a good question. So we call ourselves Coastline Capital Fund Management. Our duty is to manage everything, and so we outsource all the work. So when it comes to the notes themselves, we use note servicers. We don't do any of the servicing in-house. So the note servicer we use is SEI. They're very well known. They're basically the biggest servicer out there for private or secondary market kind of loans. They accept calls from the borrowers. They send out letters. They do all the things that are necessary for the compliance. We outsource the foreclosing attorneys and trustees that we use. So if we want to initiate foreclosure, we tell someone else to do it, and they prepare all the documents for us and guide us through the process and get signatures. CPAs, actually for our REOs, we use an asset management company. You know what? I think Sean,
Yeah, I'm
would
here.
you like to answer that? Or
Yeah, so I definitely want to.
that?
Yeah, if you guys, I want to jump in on that and definitely let people know a lot of why we use a servicer is really also for our compliance piece, so that we stay up to speed with RESPA and the regulatory laws that are mandatory for us to follow. So the servicer is there as a buffer between the borrower and the lender, and basically we guide them on what needs to be done and how it needs to be done. They come to us with questions on what we want to do. So we manage them on basically give them the answers, and they keep the compliance piece up to par. And also, like Andy was reflecting, we use attorneys across the countries to do our foreclosure, evictions, all that good stuff. We have a third-party vendor that actually does our due diligence on the actual collateral. They scrub through every document, as we do internally as well. We compare notes to make sure we have all the legal documents to be able to foreclose on it properly, that the borrower can't contest foreclosure. So there is a lot of process, but for our job, we actually manage other people to do their job, to give us all the information we need to keep up on our information to make the decisions. But yeah, so basically, when we foreclose on a property, we use a company called Coastline Capital Asset Management. I know people are going to laugh, but Coastline Capital is a sister company to Coastline Capital Fund Management. So the beauty about it is I actually know the owner of that company, and she does a very, very, very good job. She manages a lot of assets at any given time, and she goes out the best returns for us as the investors and as you guys as the investors on liquidations. She's able to manage pretty much every state in the country. She has a lot of experience, and the good thing is, guys, since I know the owner, we get a discount. So that's a bonus to the fund management company. So it's pretty cool. But yeah, I'll go ahead and turn it back to Andy. But I just want to touch a little bit on with that question about how two guys manage $10 million or $100 million. It's not just us. There's a lot of people that work for us outside of Coastline to make all this come together as one unit.
Okay, yeah. So with the asset management company, he was being a little bit shy about that, but he knows the owner because the owner is his wife. But yeah, for managing the REOs, our asset managers or Coastline Capital Asset Management will have realtors be our boots on the ground. So wherever it is in the country, we find the local real estate agents. They are in charge of doing the rehab and getting bids from contractors and doing all that kind of stuff for us. The other thing that really helps us be able to manage everything is software. So we leverage software as much as we can. I use something called Smartsheet, which lets me keep track of everything. All the different assets have so many different things to keep track of. You really need to have some kind of management software. But yeah, so I think that answers most of the questions about how we do it. We basically outsource everything and oversee everything else. A question that came in: can nonprofits invest? So the nonprofit has to qualify as an accredited investor. I don't have your exact answer for you. I can look it up on the SEC's website, or you can do that as well. The SEC has their definitions of what accredited investors are. It's easy for individuals because that's people that make $200,000 more or more per year, $300,000 or more if it's a couple, or have a net worth of $1 million outside of their primary residence. Those are easy definitions for people to understand for accredited investors. But for trusts and other entities, the SEC provides other additional guidance on that. So I'll look that up for you. Actually, it says anonymous, so I'm not sure who sent me that question. So if you wouldn't mind just sending me an email, that way I can answer you later directly. Okay, another question. What do you think about the current status of the market? How do you think it has changed due to the pandemic? So the current state of the market, at the very beginning of all of this, right before we had the lockdowns, we put a couple of our loans out for bid, and a big fund agreed to buy our loans. And then a week later, once the lockdown started happening and it was evident that everything was changing, they pulled the loans from the trade. They also backed out of a $20 million deal with someone else, so we didn't feel bad. So back then, everything just froze. People who didn't need to sell weren't going to sell. We were not going to sell our loans at a discount because we don't need to. So just about a month ago, we put our feelers back out. And we put those same two loans out for bid, and everybody, that's where that 8 to 15% number comes from, because they were people, the only people out there buying wanted to buy our stuff at a lot lower. So I think as as states reopen and we can do more and more and more, I think things will get back to normal, but they're not there yet.
Yeah, I'd like to touch on this too, Andy.
Yeah, go ahead.
Yeah, so guys, also, yeah, so the buyer guidelines now seems to be a little lower in pricing. Whether maybe it was at 70 cents 2 months ago, might be at 65 cents as when they come in for. But the good thing is we're in Fund 4, we're past all that now. So it's going to what the current real estate market is, which right now is pretty stable, or actually more active than ever, because a lot of the sellers that were selling their real estate pulled off the market because they figured, oh, the crisis, we better not sell our house. So what that did, that actually created a more competitive market by having less inventory. It became a seller's market. So going forward in Fund 5, to me, we sit in a pretty good position by going out to buy in these conditions, because if we can go out and get an additional, say, 3 to 5% off where my normal pricing is, that's just a bonus for the fund and for on the return side. Because like I said, the market seems pretty steady, but there could be if there is an influx of sales coming down, say everybody decided they want to put their houses on the market at the same time, well, then it flips to a buyer's market, which everybody now can say, well, why do I have to buy your house where I could go next to your neighbor and buy your for $1,000 cheaper? And so values might come down a little bit. But in our model, when we go to bid these things, we factor in a lot of assumptions. If you guys know how to figure, familiar with assumptions, it's kind of like trying to guess the future. So we'll actually put in there, a 5% decrease in the market for the next 12 months or 24 months. How does that look like for the bid? So the model accounts for all the inputs we put into it about what we think the market looks like 16 to 24 months out, and then it spits out a bid for where I look at it, and then I start putting human touch and instinct into it with Andy to say, listen, if it's telling us the bid 60,000, let's go ahead and back off to 57 and try to pick up a few extra $1,000 spread. So everything's definitely factored in. So that's why, again, the risk is a lot lower with this kind of investment, because the model projects what the outcome could be in 24 months. And also, we're also asset backed by that house. So again, guys, if we go out and buy these notes and say the market, God forbid, just crashes to where the value is zero, the good thing is we still own the house. If we foreclose, we still take ownership of the house. So we have other ways to make sure the investors get their money back, such as, hey, people are losing their homes. They're going to have to rent. So now we could actually take that property and turn it into a rental, and now start collecting cash flows, which would automatically go back to the investors first. So we always have an out in any condition of any market, and which is, again, the beauty about not the stock market, where you put your money there and one day it's $9 billion strong, and the next minute it's worth $1, and poof, your money's gone. You're not getting that back unless the market recovers. We stand still because we have that asset as the backer to the investment, which is a great tool to have.
All right. Yeah. So let me just add to that. So our regular sellers that we buy our regular sellers that we buy from, I don't see them giving extra discounts. I think they're more like us, where they'll do business like they did pre-pandemic, right? Because if they're sitting in a position where they don't have to sell, they're not going to sell at a discount. But that being said, we still do business with them all the time, and we can identify the deals that they have available. I think, though, that if you have these mortgage REITs that buy performing notes and they use leverage to amplify the returns, I think those guys are going to be the ones that are going to be in trouble, because they'll have to sell. They have to pay their investors, or they have to pay the banks for the debt on the credit lines, but they don't have the money coming in. I read a story the other day where it said that a lot of these funds have actually sold a lot of stuff back in March and April. If that's true, then it's probably going to take a while by the time it gets to us. And then also, we don't know what the future is going to be like. We don't know. I mean, there's all this talk about forbearances. And I really would love to see, borrowers stay in their home during this time. I mean, this is not like 2008, where there were a lot of people who got loans that should never have got them or could never afford them. This time it's been different. It's, a lot of people that were paying on their loans that can't pay them because of something that's completely out of their control. But that being said, we can't predict exactly what's going to happen to the economy over the next few years, and it might take a while for these foreclosures or these defaults to start going up. So I want to wrap this up. If there are any other questions, I can answer one more. I don't see anything coming in or anybody trying to see if they can talk. But thank you so much for everyone for joining us on this webinar and learning about Fund 5. If you have any further questions, hit us up by email. We'll be happy to answer those questions, and We hope you enjoyed your time.
Thank you guys. Appreciate it. Hopefully to see you soon.